Well, I don't know about you, but I'm so sick and tired of hearing about banks that are too big to fail. Well, what about cities and states that are too big to save? We're talking about the $3 trillion municipal bond market. It represents around 10% of the total U.S. bond market. And the State Budget Crisis Task Force just released a new report in July talking about how 6 heavily populated states, California, Illinois, New Jersey, New York, and Texas and Virginia, are in fiscal turmoil. And these 6 states are basically a microcosm of what's happening in other states within the Union, in other cities within the Union. This is what they had to say in part. The trajectory of state spending, taxation, and administrative practices cannot be maintained. In other words, states are spending themselves broke. Just one example of the type of liabilities that these cities and states and municipalities have. They showed that approximately $1 trillion of pension obligations are currently underfunded. Now, most retirement systems out there can pay pension benefits for many years out of existing funds, but that does not mean that they're sound. And the problem here, and I know $1 trillion doesn't sound like much to you, right? I mean, those numbers have been thrown around, these types of numbers over the past couple of years since the financial crisis. We've become hardened. We've become callous. $1 trillion here, $2 trillion there, $3 trillion there. It doesn't seem like anything. But it's wrong to assume that everything will work itself out in the municipal bond market. And more importantly, local governments, cities, states, unlike the federal government, they cannot print themselves out of debt, folks. So the crisis in the bond market, it will begin with the municipal bonds. And so it's very important from a money-making opportunity, if you're a trader, break below key support levels for key muni bond ETFs. They've been very, very steady. They've been very, very calm in terms of performance. But we're going to see a break very soon, a break below support, which will signal a high probability opportunity to short these particular areas. Now, we're not quite there yet, but we're monitoring that. For the rest of us, though, what it means is we need to stay away from individual municipal bond issues, especially revenue bonds, which are higher risk. And for goodness sake, don't be piling in to these high-yield muni bond funds, which is the worst possible time that you could be piling into high-yield debt or junk debt. Worst possible time of the credit cycle to be doing that. And yes, diversifying with muni bond funds, muni bond ETFs, it's a good start, but at the same time, more drastic measures may be required, like completely avoiding this particular area altogether. The August ETF Profit Strategy newsletter covers the muni bond market and other markets by identifying key inflection points, using sentiment, using cash flow, and a little bit of common sense. Lots of common sense.